Hey guys, today I want to talk about the mindset of an investor and specifically what investors and traders think about when it comes to taking losses in the market. Now, a lot of people think that trading is gambling, and I think this is a big part of why is that a lot of people don't understand how losses work in the market, and a lot of times beginning traders or new investors don't understand how to deal with it, and they end up taking bad losses and really setting themselves up for failure in the long run because they just don't understand this mindset. So, I want to show you guys this trade that I was in a little while back. It's, yep, right here on Home Depot is what this trade is. I got in right in here. You can see I was looking, there was a bounce, 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 and I think I bought in this day or this day. Whatever the case, I was looking for some upside movement up into this high area or up higher. A continuation of this trend line is what I was looking for. Some news came out, and then I think the overall market turned pretty negative right in here as well. And Home Depot, it dropped below. I ended up taking a stop loss. Not a big deal. I lost more than I normally would on this, but not a ton. But I did take a loss here, and this is what I want to look at. So, right, the mindset that a lot of traders that will have coming into a trade like this is, okay, I've got a decent little start of a trend here. I've got a beautiful little pop, right? Beautiful confirmation. Let me go ahead and buy. So they'll go ahead and buy, and then they'll say, all right, this is a super good setup. Like, I'm super excited about it. This one's going to work. And that's where a lot of the trouble comes in. Because as soon as they say, hey, this one's going to do this one's going to do that, and they don't set specific rules about what happens on the top side and what happens on the bottom side, then they get really twisted around when they have to actually go against what they want. So the next day, okay, it moves up, opens up, moves down, not a big deal, right? So our hypothetical investor here that's doing it wrong is going to say, great, this is looking good. I like how it looks. It's still holding my 20-day. It's still moving pretty well. Excuse me. And then what might happen is the next day it starts to drop and they say, oh man, this is dropping. It's below my line. I should get out, but it'll probably come back up, right? It's such a good setup, it has to come back up. And they'll convince themselves because for whatever reason they've decided this trade is going to work. It's going to do just what they wanted. They'll convince themselves that that's the case and they won't get out when they should. So instead of getting out after it drops below the 20-day, they'll just hold and they'll say, oh, well, now it's the 50-day. No doubt it'll come back up from here. And then the next day it'll drop below and they'll say, well, now it's down so far. I mean, like, look, there's a horizontal area right here, right? Maybe it'll bounce right here. Um, and they'll just convince themselves over and over and over again, okay, it's dropping, it's dropping, it's dropping, it's going against me. I'm losing and losing and losing money. But it was such a good setup, right? I can't be wrong. And I think that's where a lot of this comes in is people decide that if they can't be wrong, or if the stock goes against them, then that's on them, right? They took a bad trade when the truth is, right, this was a good setup, a good trade, and it just went against you. And that happens in the market, right? The idea is not to pick each and every stock perfectly. The idea is to take good picks, good patterns over time that you get more wins than losses. So, if 80% of the time this will come up, then that's a good trade to take. And the 20% of the times that it drops, then that's fine. And you've got to have a plan around that. And taking a reasonable stop is really, really important. So, if you hadn't taken that stop and the investors keeps convincing themselves, oh, it's dropped a few more days, but no doubt it'll go back up. It starts to go up and they go, yes, it's going back up. And then it drops down farther on, right? And so a lot of times people will take big, big, big losses, well, they'll say, oh, look, it's coming back up. I'll just hold, right? I'll just hold and no doubt it'll come back up over time, which it very well might, but they'll hold and hold and hold. And, now it's dropped. So instead of taking a $5 loss or whatever down here, then now they've taken a loss of, 18%, a $70 loss, right? So a $5 loss that's like, oh, that's a bummer, it went against me, whatever. Let me move on to the next trade. That's how it should be. But a lot of times people will look at it and they'll go, it has to go back up. So they'll take something like a $70 loss. And eventually they'll say, okay, well, this is stupid. I shouldn't keep holding on to it. Now I better sell it eventually. Or they'll just, hold on to it for a long time and convince themselves that they're a terrible trader and they took a terrible one, or, the market went against them. It wasn't their fault. When really all they had to do was take a stop out when the stock moved against them, when it broke the premise of their trade. So kind of an interesting thing here that people look at, and the mindset behind, okay, I need to take a stop because taking small stops allows me to, one, save myself from taking big losses, and two, lets me capitalize higher returns over time if I take small losses and big wins. So, for example, you take a couple dollar loss here, but maybe you make $10 when this does go up, 80% of the time. And so that's kind of the mindset behind it. That's kind of how it works. And that's why, like, taking stops really is not a big deal. It's not a bad thing at all to take a stop loss.